Most retirees assume that once their money is in the bank, it is safe. They set up direct deposit, they check their balance from time to time, they pay their bills, and they move on. But there is a category of banking mistakes that has nothing to do with spending too much or saving too little. These are quiet, invisible errors, account settings that most people set up years ago and never reviewed again. Details that are sitting inside bank accounts right now, completely forgotten, waiting to create a serious problem at the worst possible moment. And for retirees living on fixed income, Social Security, or pension payments, those problems can turn into a genuine crisis faster than anyone expects. In this video, we're going to walk through the bank account settings that retirement experts say seniors most commonly ignore and explain exactly why each one matters more in retirement than it ever did during your working years. We will talk about what happens when these settings are wrong, share a story about a retiree whose overlooked account detail caused a problem that took months to undo, and give you a clear review checklist you can use today. This is not complicated. It does not require any financial expertise. It just requires knowing what to look for. Stay with us, because some of the settings we are about to cover may already be causing you a problem you do not even know about yet. Let us start with something that seems almost too simple to be a problem. It is the question of who is listed on your bank account and what happens to your money if something happens to you. Most people set up their bank accounts years, sometimes decades ago. At the time, they named a spouse, a child, or a sibling as a joint account holder or a beneficiary. Life has moved on since then. People have passed away, relationships have changed, divorces have happened, children have had their own financial difficulties, and yet the names on that bank account have stayed exactly the same, frozen in time, reflecting a version of your life that no longer exists. This is one of the most common and most damaging banking oversights that retirees carry into their later years, and it comes in two distinct forms that are easy to confuse but critically different. The first is a joint account holder. This is someone who has full access to the account right now, today, while you are alive. They can deposit money, withdraw money, transfer money, and make decisions about the account exactly as if it were their own. If your joint account holder develops a gambling problem, gets sued by a creditor, or simply makes poor decisions, your money is at risk. Their creditors can, in certain circumstances, come after funds in a joint account. The second is a beneficiary designation, or what is sometimes called a payable on death designation, often written as POD. This is different. A POD beneficiary has no access to the account while you are alive. But when you pass away, the funds transfer directly to that person, outside of probate, outside of your will, and outside of any other instructions you may have left. The bank does not check your will. It does not contact your estate attorney. It simply transfers the money to whoever is named. Here is why this creates a problem. If you updated your will after a divorce but forgot to update the POD designation on your bank account, your ex-spouse may legally receive that money. If you named a child who passed away before you and never removed their name, the transfer could become complicated and potentially tied up for a long time. If you named no one at all, the account goes through probate, a slow, public, court-supervised process that can take months and cost the estate real money in legal fees. Take 15 minutes today and contact your bank. Ask them to show you every beneficiary and POD designation on every account you hold. Then ask yourself honestly, does this still reflect what I want? If the answer is anything other than a clear yes, update it immediately. Now let us go deeper, because the beneficiary issue is just the beginning. Let us talk about a man named Frank. Frank was 74 years old and had lived in the same house in eastern Pennsylvania for nearly 40 years. He had retired from a manufacturing job at 66, and between his pension and his Social Security, he brought in a modest but reliable income each month. He was not rich, but he was steady. He paid his bills on time. He kept a few $1,000s in his checking account as a cushion. He considered himself financially responsible. What Frank had not done in 12 years of retirement was sit down and actually review his bank account settings. He had set up automatic bill payments back when he first retired, linked his checking account to his electric company, his phone provider, and a magazine subscription he did not even remember signing up for. He had set up overdraft protection at some point, though he could not recall the details. And he had listed his wife as a joint account holder, which made sense at the time. His wife passed away 3 years before this story takes place. Frank never updated the account. Then, one October, Frank's electric company switched billing systems and accidentally double-charged him for the month. The duplicate charge, combined with a large quarterly insurance premium that hit the same week, pushed his checking account below zero. The overdraft protection kicked in, transferring money from his savings account to cover the shortfall, but also triggering a fee. The fee triggered a second shortfall, and because his Social Security deposit was not scheduled to arrive for another 9 days, the account stayed negative. What Frank did not know, because no one had ever told him, was that several of his automatic payment providers were set to retry failed payments. When the first attempt failed, they tried again 2 days later. Each retry triggered another overdraft fee. By the time Frank noticed, his checking account had been hit with multiple fees totaling over $150. He called the bank. They reversed some of the fees, but not all of them. He spent nearly 3 weeks trying to reconcile what had happened and restructure his automatic payments so the billing dates lined up better with his Social Security deposit date. The hardest part for Frank was not the money, though that was painful enough on a fixed income. The hardest part was realizing that all of it was preventable. A simple account review, something that would have taken an hour, would have caught the misaligned dates, updated his account settings, and protected him from the entire cascade. Frank's story leads us directly into the next setting that retirees overwhelmingly ignore: automatic payment alignment. When you are working and getting a paycheck every 2 weeks or twice a month, your checking account is being refilled regularly. A bill hitting on the wrong day is not a crisis. Money flows in frequently enough to smooth things over. But in retirement, most people are living on a monthly Social Security payment, a monthly pension, or a combination of both. That money arrives on a specific day. If your automatic bill payments are scattered across the month with no attention paid to when income arrives, you are running a gauntlet every single month, hoping that nothing large hits before the deposit lands. Social Security payments follow a predictable schedule based on your birthday. If your birthday falls between the 1st and the 10th, your payment arrives on the second Wednesday of the month. If your birthday falls between the 11th and the 20th, payment arrives on the third Wednesday. If your birthday falls between the 21st and the 31st, your payment comes on the fourth Wednesday. Pension payments typically arrive on a fixed date each month. If you have never mapped your automatic payments against your income schedule, now is the time. Log into your bank's online portal or call them and ask for a list of all automatic debits on your account. Then look at the dates. If large bills, insurance premiums, utility payments, subscription services are consistently hitting your account before your income arrives, you are creating unnecessary risk every month. Most billers will allow you to change your payment date with a simple phone call or online request. Move large automatic payments to a day or two after your regular deposit date. It is a small adjustment that eliminates a recurring vulnerability. Now let us talk about FDIC insurance and why the way your accounts are set up may be leaving some of your savings unprotected. The Federal Deposit Insurance Corporation insures deposits up to $250,000 per depositor, per insured bank, per account ownership category. That last part, per account ownership category, is the piece most people miss. Here is what it means in practice. If you have $150,000 in a checking account, $100,000 in a savings account, and $50,000 in a certificate of deposit, all at the same bank, all in your name alone, you are not covered for the full $300,000. You are covered for $250,000 total for all accounts in your individual name at that institution. The remaining $50,000 would be at risk in the unlikely but not impossible event that the bank failed. However, the coverage calculation changes depending on ownership structure. A joint account with a spouse is insured up to $250,000 per co-owner, meaning a joint account could carry up to $500,000 in coverage. Certain retirement accounts like IRAs have their own separate insurance categories. None of this requires moving your money. It simply requires understanding how your accounts are categorized so you know whether you are fully covered. If you keep significant savings, more than $250,000, at a single institution, it is worth a call to your bank or a visit to the FDIC's online tool called EDIE at fdic.gov. It walks you through your specific situation and tells you exactly how much is protected. Let us now address something that catches retirees off guard with surprising regularity: the auto-renewal trap buried inside certificates of deposit. Many retirees use CDs as part of their saving strategy, a stable, predictable place to keep money and earn a modest return. They set it up, they wait for it to mature, and then, if they are not paying attention, it rolls over automatically into a new CD at the current rate, which may be dramatically lower than when they first opened it. and now their money is locked in again for another term. The problem is that the bank's notification about an upcoming maturity date can be easy to miss. It might arrive as a single piece of mail or a single email or a single online notification. If you are traveling, dealing with a health issue, or simply not checking that account closely, the window closes. Most CDs have a grace period of 7 to 10 days after maturity, during which you can make changes without penalty. Miss that window, and your options are limited. This is especially painful when interest rates are declining. You may have locked in a strong rate a year or two ago, and if your CD rolls over automatically, you could be locked into a much lower rate for another full year or more. The fix is simple, but requires being proactive. Find out exactly when each of your CDs matures. Set a calendar reminder at least 30 days before that date. And when the maturity date approaches, make a conscious decision about what you want to do, rather than letting the bank make that decision for you by default. Now let us talk about online banking security settings and why many retirees are leaving themselves exposed without realizing it. Banks offer a range of account alert settings that most people never turn on. These alerts can notify you by text or email when a deposit arrives, when a withdrawal exceeds a certain amount, when your balance drops below a threshold you set, or when a new payee is added to your account. For retirees on fixed incomes, these alerts are not just convenient. They are a layer of financial protection. Consider what an alert could catch. If your Social Security direct deposit does not arrive on its expected date, an alert would tell you immediately, rather than leaving you to discover the problem when a bill bounces. If someone unauthorized makes a transaction on your account, an alert would surface it within hours, rather than letting it go unnoticed until your next statement. If a subscription service quietly raises its charge, an alert would flag the new amount. None of these alerts cost money. Most banks offer them for free. But the majority of retirees, particularly those who set up their accounts before smartphone alerts became standard, have never turned them on. If you have not set up account alerts, log into your bank's online portal today or call your branch and ask a representative to walk you through the options. It takes less than 20 minutes and creates a monitoring layer that works around the clock. There is another account setting that deserves specific attention, and it involves the way your direct deposit is currently structured. Many retirees receive Social Security, a pension, or both via direct deposit into a single checking account. That is the account they use for daily expenses. It works, but it carries a risk that most people have not thought through. If that account is ever frozen due to suspected fraud, a legal dispute, or even a bank error, every incoming deposit hits a wall. Your Social Security payment arrives and sits inaccessible. Your bills go unpaid. And the process of getting a frozen account unfrozen can take longer than most people expect. One way to reduce this vulnerability is to maintain a separate account at a different financial institution for emergency reserves. This does not have to be complex or large. Even a few months of essential expenses sitting in a separate institution creates a financial firewall. If your primary account ever has a problem, you are not completely without access to money while the situation is being resolved. This is also relevant to FDIC coverage discussions, to estate planning flexibility, and to the simple peace of mind that comes from knowing your financial foundation has more than one pillar. Let us also spend a moment on required minimum distributions, because for anyone over 73 who holds a traditional IRA or a 401k, these are not optional, and missing them carries a significant IRS penalty. The IRS requires that you begin withdrawing a minimum amount from these tax-deferred accounts each year. That amount is calculated based on your account balance and your age. What does this have to do with banking? More than people realize. The calculation must be done correctly. The withdrawal must actually arrive in your account. And many people who are managing this process themselves, without a financial advisor, are doing the math on last year's balance instead of the required year-end figure. Or they are taking the distribution late, or they are consolidating multiple IRAs without accounting for the combined RMD requirement. The penalty for not taking your full required minimum distribution is steep. Historically, the IRS has penalized up to 25% of the amount you failed to withdraw, though this has been subject to updates and there are correction procedures available. This is a bank account setting in the broadest sense. It is a scheduled, required transaction tied to your accounts, and it needs to be verified and managed every single year without exception. Finally, let us talk about fee structures. This one feels small, but over the course of a 10 or 15-year retirement, the numbers are not small at all. Many banks charge monthly maintenance fees for checking accounts that fall below a certain balance. They charge ATM fees when you use a machine outside their network. They charge overdraft fees, paper statement fees, wire transfer fees, and in some cases, fees simply for calling customer service. For someone living on a fixed income, these fees represent real money that is being quietly drained month after month. The banking landscape has changed significantly. There are now many banks and credit unions, both in person and online, that offer fee-free checking accounts with no minimum balance requirements, no monthly maintenance fees, and robust customer service. If you are currently paying fees on your bank account, it is worth asking your bank what it would take to eliminate them, whether that means adjusting your account type, meeting a balance threshold, or simply switching to a product better suited to a retiree's needs. This is not about uprooting your banking relationship. It is about making sure the bank is working for you, not the other way around. We have covered a lot of ground today, and we covered it deliberately, not to overwhelm you, not to make banking feel like a second job, but because every single issue we discussed represents money and security that belongs to you, and that can slip away quietly if no one ever tells you to look. Let us bring it all together simply. There are 6 areas worth reviewing in your bank account this week. The first is your beneficiary and payable on death designations. Find out who is listed on every account, every CD, and every savings product at your bank. Make sure those names still reflect your actual wishes and your actual life. The second is your automatic payment schedule. Map out when your income arrives and when your bills go out. Make sure large automatic payments land after your deposit date, not before it. This simple alignment change can prevent overdraft cascades like the one that hit Frank. The third is your FDIC coverage. If you keep more than $250,000 at one institution, use the FDIC's EDIE tool online to verify how much is actually insured. The tool is free and takes only a few minutes. The fourth is your CD maturity dates. Know when each one matures. Set a reminder 30 days in advance. Make a conscious decision at that point rather than letting your money roll over automatically into a lower rate. The fifth is your account alerts. Turn them on if you have not already. Alerts for deposits, large withdrawals, low balances, and new payees give you a real-time view of your account activity without requiring you to log in every day. And the sixth is your fee structure. Know what you are paying each month for banking services. If you are being charged maintenance fees, overdraft fees, or ATM fees regularly, ask your bank what your options are, or explore whether a different account type would eliminate those charges entirely. None of these steps require a financial advisor. None of them require special knowledge. They require only time and attention, and the willingness to look at things that are easy to ignore because they have been there for years without causing a visible problem. The time to review these settings is not when there is a crisis. It is right now, when everything is calm, when you have the mental space to think clearly, and when any issues you find can be corrected without pressure. Your bank account is not just a place where your money sits. It is the foundation of your daily financial life. It is where your Social Security payment lands. It is where your bills come from. It is the account that protects your savings, funds your needs, and ultimately passes something on to the people you love. It deserves more than a passing glance. Take an hour this week, review your settings, make the changes, and then give yourself the peace of mind that comes from knowing that your financial foundation is exactly as solid as it should be. You have worked hard for every dollar in that account. Make sure the account is set up to protect it.